Hey everyone, welcome back. This is Andrew Jordan from NodeWise CPA. If you're on a managed service provider, depreciation planning matters more than you might think because equipment, tools, and technology purchases can create both tax savings and cash flow flexibility. In this video, we're going to talk about depreciation, specifically how to use bonus depreciation and Section 179 strategically. This is one of those areas where the rules keep changing, and if you really understand your options, you can make them work for you. Before we dive in, let me start with a usual disclaimer. This video is for educational purposes only. It's not tax or legal advice. Everyone's situation is unique, so you should always talk with your own professional before making decisions. Also, I'm recording this video in 2026. All right, let's talk depreciation. First, bonus depreciation. With the new tax legislation, the big beautiful bill, bonus depreciation is back up to 100%. That means if you buy qualifying assets like equipment, you can write off the full cost right away in the year you place it in service. This is a big deal because it accelerates your tax savings. Instead of spreading deductions over several years, you get the entire benefit up front. Now here's the catch. Bonus depreciation is an all or nothing election for each class of assets. So if you buy several pieces of equipment in the same category, you either depreciate all of them using bonus or none of them. That's efficient in some cases, but it doesn't always give you flexibility. That's where Section 179 comes in. Section 179 lets you pick and choose. You can decide which assets you want to expense and which ones you want to depreciate over time. So maybe you want to fully expense one piece of equipment this year, but spread another purchase over several years. Section 179 gives you that control. And here's something that a lot of people miss. Section 179 isn't just about this year's tax savings. Sometimes a smarter play is to smooth out deductions over multiple years. Why? Because if you use bonus depreciation and take it all once, you might push your income down so low one year that you waste deductions. You could have used those to offset higher tax income in future years. Section 179 allows you to be more strategic, keeping your taxable income in a lower bracket year after year instead of taking a giant deduction one year and nothing later. Now, I want to expand on the idea a bit because it's one of the ways I really like to use depreciation strategically with clients. Remember, the US income tax system is graduated. The first dollars you earn are taxed at zero, then 10%, then 12%, then it jumps to 22%, 24%, goes up from there. So one of the things I like to do with clients who are consistently profitable is to use depreciation to smooth out their income, which is especially helpful for MSPs with lumpy revenue from big projects. You're going to pay a lot less total tax having, say, $100,000 of taxable income every year than having zero income for 2 years and then $300,000 in the third year. That's because those lower brackets, the 10% and 12% ones, those are your cheapest dollars. I like to tell clients to harvest the 10 and 12% brackets. If you know your business is stable and profitable long term, I don't generally like to use depreciation to bring your taxable income all the way down to zero. The reason is that's wasting those low rate brackets. I'd rather see you land in the 100 to 125,000 taxable income range, give or take, enough to fully use the 10% and 12% brackets without spilling into those higher brackets unnecessarily. And one thing that comes up here, people sometimes worry that taking depreciation will make them look less profitable to banks or make it harder to get financing. That's not how this thing works. This comes up a lot with MSP owners who are thinking about financing growth or doing an acquisition or maybe selling. It's important to know depreciation doesn't hurt you in any of those conversations. When a banker looks at your financials, depreciation gets added back to your income for lending purposes. So it helps you on your taxes, but it doesn't hurt you when you're applying for loans or coming to sell your business. So let's recap. Bonus depreciation is simple and powerful. It's really good. We use it often. 100% write-off currently, but it's all or nothing by asset class. Section 179 gives you more flexibility to pick and choose and to spread deductions across years strategically. We often use both in conjunction. The smart move is to align these choices with your business cash flow, your tax bracket management, and your long-term profitability, not just with what looks good for the current year. That's it for today's video. In the next one, we'll talk about S corporations, the benefits, the pitfalls, and some details people often overlook. And if you're a client and want to look at these strategies and how they fit your business, let's chat. If you're not a client yet, but you're running a successful business and want to explore the broader services we offer, feel free to reach out. Thanks for tuning in, and I'll see you in the next video.